Bitcoin just bounced toward the 66K zone, and on the surface, it looks like the fear is finally disappearing. The chart is green, risk assets are moving again, oil pressure is cooling down, and the market suddenly feels more optimistic than it did just a few days ago. But this is exactly the moment where many investors make the biggest mistake. They look at the price, they see Bitcoin moving up, and they assume the breakout has already been confirmed. But in markets, price is only the first signal. The real question is not whether Bitcoin moved higher. The real question is whether big money confirmed the move. That is the signal we need to watch now. Because Bitcoin can bounce for many reasons. It can bounce because short sellers are closing positions. It can bounce because fear cools down for 1 or 2 days. It can bounce because traders are reacting to one headline, one macro event, or one temporary shift in risk appetite. But a real sustainable move usually needs something deeper. It needs liquidity. It needs institutional demand. It needs ETF flows. It needs the kind of capital that does not just chase one green candle, but actually supports the next leg of the market. Right now, the macro backdrop has changed fast. The market is reacting positively to the US and Iran preliminary deal. Oil prices are falling, stock futures are rising, and investors are moving back into risk assets. That matters for Bitcoin because Bitcoin does not trade in isolation. When oil is rising, inflation fear usually rises with it. When inflation fear rises, the Fed becomes more difficult for markets. When yields stay high, speculative assets struggle. But when oil falls, volatility cools and yields soften. Bitcoin gets a better environment to breathe. That is why the bounce makes sense. But a better environment is not the same thing as full confirmation. This is where the calm metrics framework becomes important. We do not just ask, did Bitcoin go up? We ask, who bought it? Was it spot demand? Was it ETF demand? Was it leverage? Was it short covering? Was it real capital or just a temporary reaction? Because if Bitcoin moves up while ETF flows remain weak, then the rally is not as strong as it looks. If Bitcoin moves up but institutional demand does not follow, then the price can still be vulnerable. If Bitcoin moves up but liquidity does not expand, then the market can still trap late buyers. This is why the ETF flow data is the missing signal. After several weak sessions, Bitcoin ETFs finally showed a positive inflow again, and that helped the market narrative. But one positive day is not the same thing as a full trend reversal. For this move to become more serious, we need to see repeated inflows, not just a single green number. We need to see buyers come back consistently. We need to see Bitcoin hold the key zone instead of just touching it. And most importantly, we need to see the market stop treating Bitcoin like a temporary trade and start treating it like a destination for capital again. The danger here is simple. When Bitcoin moves from fear back towards 66K, it attracts two types of buyers. The first group is strategic. They wait for confirmation. They watch flows, liquidity, macro conditions, and structure. The second group is emotional. They see the green candle, feel late, and rush in because they do not want to miss the move. Markets often punish the second group, not because Bitcoin is weak, but because timing matters. A good asset can still be a bad entry if the confirmation is not there. So the next question is not, can Bitcoin go higher? Of course it can. If ETF inflows continue, if yields remain calm, if oil stays lower, and if risk appetite keeps improving, Bitcoin can build on this move. But if the ETF flows fade again, if the Fed stays hawkish, if yields rise back, or if the geopolitical relief trade reverses, then this 66K bounce can quickly turn into a liquidity trap. That is the difference between a real breakout and a fake comfort rally. This is also why the 66K area matters psychologically. It is not just a number on the chart. It is a decision zone. Above it, people start believing the worst is over. Below it, people start questioning whether the bounce was only temporary. That means Bitcoin does not only need to touch this zone, it needs to prove it can hold it. And the proof should not come from social media excitement. It should come from flows, structure, and follow-through. For retail investors, the lesson is clear. Do not let one green candle make the decision for you. Watch the confirmation. Watch ETF flows. Watch whether institutional demand returns for more than one day. Watch whether Bitcoin can hold above the key zone without immediately giving back the move. And watch whether macro conditions continue to support risk assets. Because in this market, price tells you what happened. Liquidity tells you whether it can continue. So yes, Bitcoin hitting 66K is important. It shows that fear is cooling. It shows that risk appetite is returning. It shows that the market still wants to believe in the next upside move, but the missing signal is still confirmation from big money. Until that signal becomes stronger, this is not the moment to blindly celebrate. This is the moment to observe calmly. Because the best investors are not the ones who react first. They are the ones who understand what must confirm next. And right now, the message is simple. Bitcoin has moved. Now ETF flows, liquidity, and institutional demand must prove whether this move is real.